Everyone, thanks for joining. We've got a couple more minutes until we actually go live. So I'm just going to put myself back on mute, get everything set up, and then in probably 2 or 3 minutes, we'll start heading into does your ISA beat inflation? And with inflation skyrocketing, can your savings actually keep up? And if they can, how can you do that? Hey everyone, thanks for waiting. There's still a couple of people coming in, but we'll get going. The topic of today's ISA, as you're more than aware, is does your ISA beat inflation? With inflation skyrocketing, can your savings actually keep up? We'll run through the current market, how everything's looking. We'll look at a few comparisons. We'll look at the Bank of England monetary report from May. We'll delve into it at quite a high level, going through quite a lot of different subjects, with the aim of today to help give a bit of education in terms of inflation, what's happening out there, and what opportunities there are to potentially beat inflation with 2 ways, really. The first one just being a standard investment, and then can you supercharge that with tax-free returns on investments utilizing an ISA? So today it's myself, John Wilson, the Relationship Director here at Sourced Capital. My roles and responsibilities are chatting with our investors on a day-to-day basis, running through their investment goals and different opportunities that we have here at Sourced Capital. One of the main topics that I've spoken about probably over the last 3 months has been about inflation, whether that's companies looking to invest to outweigh the impact of inflation in the company profits that they have, or whether it's individual investors which are looking at the market thinking inflation's at X%, which we'll delve into shortly, and what can I do to overcome that? And today we're lucky to be joined by Derek Pratt, who's the Commercial Director at Sourced Capital. Derek, are you with me?
Hi, good afternoon, everyone. I am with you, John. Coming to me from the soundproof booth that is neatly tucked away in our new office. So yes, good afternoon, everyone. As John says, we're looking forward to just giving an overview as to clearly what's a piece of news that's seeing quite a lot of heavy exposure with regards to what's happening with inflation, general sort of pressures on income, obviously how that impacts savings and our daily lives, really. But I'm sure more of that will come out as we go through these slides.
Perfect. Thank you very much. We'll hold the webinar kind of like a podcast as well, so we'll be open to discussion right the way through between ourselves. Again, this webinar isn't financial advice. It's a look at the current UK economy using the most recent Bank of England monetary report for the information regarding inflation, what their plans are, what their targets are. During the webinar, we will talk about different investment opportunities. These will be from Sourced Capital, and these opportunities are purely for sophisticated and high net worth individuals. Your capital is at risk with the investments that we're talking through, and you may lose capital that you lend. And obviously, peer-to-peer investments are not covered by the FSCS. However, they are covered by the FCA. As I mentioned, we'll run it as a bit of a discussion. We'll run it as a Q&A style right the way through. If you've got any questions, fire them onto the chat box. We'll delve into these. We could even open up the floor if somebody's got a further question that they want to ask and want to be involved in the conversation. Feel free to stick a hand up and we can do that for you. So Del, I'll let you run through the official inflation rate as where it is today, and what the aims are really, and what the expectations are over the next few weeks, months, and potentially years with Bank of England.
Thanks very much, John. Yeah, I think the heading should be a really quite straightforward question, really, shouldn't it? What is the official inflation rate? Well, I guess the official inflation rate is 9%. Because that's what the Consumer Price Index says. But for any of us that are reading the press, listening to the radio, watching the telly, there's that's not the only number that gets sort of brandished around. So, is it 9%? Is it 7.8%? Which is, the CPIH. What is the CPIH? What's happened to retail price index, which some of us at a certain age will have recognised as how inflation was previously assessed. So, it's not meant to be a boring economic seminar or a textbook read, but very, very quickly, the CPI is the internationally recognised measure. It's the harmonised measure that we use in the UK. And that is the figure that the government and the Bank of England will use when they're sort of making reference to how we're doing against targets and expectations. So, we can talk about in the Q&A maybe later as to what the differences are. But, all three of these are published, and they're published every month, because different people in different areas will be looking to see what these figures are, because it will impact their various contracts. They might have a savings scheme, they might have a pension that's indexed to one of these key measures. So there are different measures, but for absolute sort of clarity, the figures that is the harmonised international rate, the one that's recognised, the one that the Bank of England reference, it is the CPI, the Consumer Price Index, and that in the last month was at 9%, which is quite a significant rise. That 9% is a representation of the movements over the previous 12 months, and it moves up from where we were last month at a figure of 7%. So 7% to 9%, clearly a big number. The Bank of England's best guess at the moment is that figure will increase into double figures this year, and that it's going to take a while to get through to their target, which will be referenced on a later slide.
Perfect. Thank you very much. So just in the meantime, I've just had a chat box pop up straight away. One of the attendees are unable to see the video. If I can just ask other attendees if they can see the video, just to type in the chat box if they can see it, or if they can't, just to help each other. And if we can't see it, let's get this sorted. Oh, perfect. We've got a few of the yes coming through. Yeah, we've got quite a lot of yeses. So I'm not sure if there's any issues on your side on the video. We will be recording the full webinar right the way through, and we will be able to send that through for you. Oh, perfect. Yes, it is just a screen on today. We've not got any videos on the hosts for today, so that'll be the reason why. So I'll pop on to the next slide, and here we start to look at what is the Bank of England's target rate for inflation. So obviously the clear number that they've stated is 2%, and we'll run into the proposals, and I'll let Del dive into these in a lot more depth of what they're looking to do. But from interest rates of 9% currently, moving into potentially by Q4 at the end of this year, moving into 10%, the target rate of moving inflation back down to 2% is quite a heavy target. And the proposals that have been set forward by the Bank of England are as such. And Del, I'll let you take this one away as well.
Okay, thanks, John. Again, sort of how to keep this, it's some people think it's an incredibly boring subject. For me, probably says a lot about me. I think it's a massively interesting subject, the whole economy thing and how you can control it. But if we get to the principal point of what is the Bank of England's role in this? Well, they are supposedly independent of the government, and their key task is to get that inflation, is to be able to use interest rate movements to help the wider economy. Now, it's not their only sort of tool in their toolbox, but interest rate increases and decreases is pretty much the main item that the Bank of England carry around with them when they're looking to impact inflation. Now, that slide pretty sums up a reasonably complex thing very, 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 very well. How do you stop inflation? How do you stop prices increasing month on month, year on year? Well, if you come back to the very basic, assumption that supply and demand are the key component. You look to weaken demand, you look to weaken how much sort of spare cash there is in the general economy, that's pushing these prices up across the various, what is it, 9 or 10 areas that contribute to the CPI. And the Bank of England does that by increasing interest rates. We can see that there's been 3 increases in the last 4 months, following a period where there was absolute stability on the interest rate situation. So they reduced that. Look at that, that was by magic, that, John. Well done, mate.
Perfect timing.
So it's like witchcraft, this. So yeah, I mean, that slide sums it all up. I mentioned there that there was long-term stability. Absolutely there is. If you look to the left-hand side of that slide, you know, it's showing the rates come down from 6%. Again, depending upon the age of people that are listening to this, you know, if we take that further back, and it's, you know, it's in my lifetime that, you know, they're well into double digits. So, you know, let's bring that down from 2008 onwards, really, really stable. We've been used to a well-controlled, low inflation, low interest rate economy for quite some time. Now, why we see that drop down to 0.1% and now sneaking back up? Well, you know, the 0.1% was to try and boost the economy. So it was a drop from, you know, they couldn't really drop it much further because it was already at quarter, but they did. They dropped it down to 0.1. Some other economies around the world, other central banks even went into negative rates. And that was all to try and help drive the economy during the pandemic. We're now coming out of the pandemic. We've now got all the other issues that are impacting supply and demand. You know, and supply is a big part of that. You know, if we just look at what's happening in, you know, in Russia and Ukraine, and we look at you know, the obvious implications of what's come out of those sanctions. If we look at the problems in China with, you know, regular lockdowns, that's clearly impacting a lot of availability of supply, and demand has been high. People have had spare cash, so that's why we're seeing the rates starting to increase. Bank of England are reasonably coy with regards to how far they will increase that interest rate, and understandably won't put a number on it. But you know, I think just before we move off this slide, one thing I would say is, you know, it's quite easy to be almost sort of, I don't know, almost dismissive of the fact that interest rates have risen by, you know, up to 1%. You know, what is 1% for those of us that are used to much higher numbers than that historically? Well, just put it in context, I suppose. Even if you've only got a £250,000 mortgage, you know, that's 2.5 grand's worth of interest. Now, there's clearly people with much bigger mortgages than that. And you add that on to all the other increasing costs. And do you know what? It won't take long before people suddenly realise they haven't got that much spare cash in their pocket.
Thank you, Del. Really good overview of interest rates and how they've moved. And again, similarly, we're comparing this through to inflation. And as I mentioned earlier, we've got an expected rise to around 10% in the Q4 of this year. And the economy is due to slow due to the reasons that I've mentioned so far. And to increase to 10% and then bring it right back down to 2%, there will be a few changes that come. And there's a few reasons why. Obviously, we've been impacted. COVID was the main one. There's further lockdowns in China, which are making it a lot harder to import materials and products over. And then obviously you've got the Ukrainian-Russia war, again, causing issues with fuel prices and shortages right the way through. Have you got anything else to add to this slide, though? I know we've delved into it quite a lot so far.
Yeah, I think the only additional thing I would say to that slide is that that's the Bank of England's latest prediction. If we'd have looked at that 3 months ago, the Bank of England predicted a peak at 9%, which was on top of a peak of 7%. So, you know, it is a moving feast. That is economics by definition. You know, yes, there's a lot of theories behind it, but, you know, actually predicting the numbers that come to it is pretty difficult. But absolutely, you know, that the peak in that prediction has moved significantly in the last 5 months from the Bank of England.
Just a question that's come through here from Andy. So thanks, Andy, for getting involved. We've got any ongoing consequences of Brexit, do you feel, Del? Do you think this is a longer term play from a couple of years ago?
Absolutely. I think it's a great point, well made, and one that, you know, in fairness, should have mentioned in the general summation. Yeah, let's come back to supply and demand. I don't want to get political about this, but I think it would be difficult for anyone to argue that it is easier to trade as a result of Brexit at the moment. And if that has been the impact, coinciding when it did with, the added complications of COVID and a general slowdown across, not just Europe, but clearly the world. Yeah, I don't think there's any doubt that there's a part to play with regards to, the Brexit thing not absolutely unraveling or finding, how it's going to look long term yet. So yes, I in my true style, John, that was a yes/no question, and I'm giving a ridiculously long answer. But I do agree with the party that's asked that various point.
Perfect. And yeah, just an extension to that point, just from Andy saying the increase in raw materials and the costs that they've put on top of them has been quite huge. So yeah, I think we're all feeling that impact as well. So what can we do to try and outweigh that, or to try and beat inflation? And one of the key ways really is to have your money working a little bit harder for you. And we'll delve into the overall market, what's been happening in a few comparisons, and the different ways that a lot of investors are looking to potentially start to invest or continue to invest or change their strategy to help beat inflation, because it's quite challenging trying to find a investment opportunity that's consistently going to hit double digits to stay above the rate of inflation, which we're currently at, or future inflation is going to be. So a few that we've put through today are, you've got buy-to-let investments that we'll touch on. We've got stocks and shares style investments, keeping cash in the bank. Does that work? And then investments into what we do here at Sourced Capital, which are UK property developments. So we'll move into these slide by slide. Again, any questions on any of these, just pop up, or any difference of opinions, pop up, and let's have a conversation about them. But the first one that you see is direct property ownership. Buy-to-let's a simple, straightforward strategy within property of buying, holding, and renting a property out. And across the board, obviously, there's straight away people who are saying, yeah, but you can leverage and get a mortgage. But the average yield across the UK is 3.63%. That's looking into the different regions, looking at the different average prices for properties. Over the last probably 2 years, the housing market has been in a really good condition in terms of the sales prices are relatively high. It's quite a buoyant market. And you can see that with the house prices increasing month on month over the last 2 years. The slight drawback with that is the rents haven't kept up at that same pace. So the yields have started dropping in quite a lot of areas. Del, any questions or any queries on those, or any future further points?
Yeah, it's like everything, isn't it? There's a lot of component parts to this, and depending upon who you are as the investor and what you need out of this, whether it's, you're looking for long-term growth, whether you're looking for cash, what your position is with regards to debt. But if you look at, every single one of those columns that you've put from, even from region, then through to your price, so your average rent, all of those, if you think about it, you can't just take the rental yield in isolation, because some of those areas have seen huge capital gain. So at which point the overall return is, is worth maybe even the fact that your rent isn't covering the costs of ownership and finance. But what happens if that really strong buoyant market that you've just referenced, John, doesn't continue on that upward curve? Mm-hmm. Well, and it either remains stable. Now that, in a difficult economy, you might say stable prices is a good thing. Well, it's not if you've gone into it looking for capital growth. The rents, even that is a massive discussion point, isn't it? Because certain areas have seen demand go up and down, and do people want to live in the cities? Do people want to move out the cities in the pandemic? People are now looking to move back. Your average rent, every one of these component parts, depending on which property you're looking at and who that investor is, will definitely have deeper and further considerations to make. But the point that clearly jumps off this page, isn't it, is that an average yield of 3.63% in isolation isn't keeping up with the inflation at the levels that they're talking about. So if you're not massively confident that you're going to see increases in the value of that property, it's something else to add into the mix when you're thinking about your strategies.
Absolutely perfect. Thank you very much. So then the next avenue, unless anyone's got any further questions on that, I know Andy has just popped up with a question, but I don't know if Del saw that, but it was almost perfect timing if he didn't. Talking about capital appreciation. As soon as the question came up, you answered it. So surprised that you didn't see it come through. So yeah, anybody else got any questions on direct property ownership on a simple strategy such as buy to let? Nothing coming through as of yet. If it does, we'll pop back to it. Oh, yep. Andy's come back to say, yep, answered that. So that's great. The next one that we'll look at, this again, similar to what Del said, there's so many moving parts within the stock market. Over the last probably 2 or 3 months, we've seen huge negatives, a lot of traction with things that we've mentioned so far, the economy, the wider scale. And this just puts into perspective, based on the stock market over the past year, that was year to date, looking at yesterday and today's stats. You've got one there, which is showing us a nice outlier, the FTSE 100 at a plus 6.29%. S&P 500 minus 5.32%, FTSE 250 minus 11.07%. Individual stocks, again, have taken quite a turn over the last few months. So Netflix, obviously there's a wider discussion on Netflix and its subscriber base, but down 62%, Amazon 33%, Meta platforms, if you're not familiar, Facebook, Instagram and so forth, 39%. Ford down 1.76%, and then you've got Microsoft leading the way on individual stocks at a very high level at 3.94%. Again, you can be in and out of stocks and shares right the way through. We've got Andy that's popped through, bit selective there on the exceptions. BP, we've got 33.5% up in the last year. Yeah, we took a random selection of the most active stocks within the tech and the motor industry. And obviously you've got the regular funds that have come through. Another example, Shell 69. There will be many examples of many stocks which are up, down, in between, right the way through. So yeah, it was a selection, just showing that there are some which have lost, some which have gained. But yeah, Shell 67.29% up in the last year. We've got BP, which are 33% up. So there's many more to delve into. But from yourself, Del, any points on that, discussion points?
No, I mean, I think as a wider point, if you're in sort of oil and energy and you're not making money at the moment, you're never going to make money. So I think the points Andy makes there are absolutely right. But what I would extend out from that is that the figures that are on that slide that's in front of us represent, a basket of stocks and shares. And those big companies that we've just referenced there that are in energy and oil are going to be included. So, if there's some big winners, that must mean there's some big losers in there as well, which obviously we can see some of those big losers, which therefore impact, the 100, the 250, the wider 500s. And let's not forget, these are stocks and shares. These are done on a 12-month basis to represent the same 12-month period that we're looking at the inflation figures. people, this isn't intended to say you cannot make money on the stock exchange. There'll be people that will have made money by shorting or selling, the Netflix position. So the fact that, it's gone down 62% a year doesn't mean that some person or people or organizations haven't made money. It's just there to try and give, a broader view as the market as is possible, because I guess, a lot of us that rely on institutions to invest across a wide number of stocks and shares are going to be impacted by what's happened on that broader basket that's shown on those indices.
Perfect. Thank you very much. Again, every slide we'll ask a question if anyone has any questions. So we'll leave it on there for a couple of seconds, see if anything pops through. If it doesn't, we'll move on to the next slide. We have got a question here, which is, I don't know if the attendees can see the questions, but we've got one regarding Sourced Capital and investments from borrowers. What we'll do, we'll answer that more towards the back end on the Q&A, just because there's quite a few new people to the webinar today. So we'll explain what Sourced Capital is, explain how it works, and then we'll look at the borrowing side of things as well. So I'll make a note, George, and we'll come back to that one towards the end of the webinar, if that's okay. So we'll move on to the next slide. And this is a brief overview of what Sourced Capital is. So Sourced Capital, effectively, it's a peer-to-peer investment platform, which allows investors to invest into UK property developments. So far to date, we've raised just over 25 million, repaid around about 15 million. And these are the key components that you'll see with it. So with ourselves, we can earn up to 12% per annum. And that can potentially be through tax-free means, which we'll look at the ISA, and obviously you've got SAS investments as well. There is a first charge security, which is held over the asset itself, and then there are no fees to invest from our investors. Remember, capital is at risk. There's no FSCS protection, but the platform Sourced Capital is FCA regulated. So again, Dale, I'll let you jump into this one, really. And it's quite a simple graph when you look at it. So again, we've brought in varying levels of different types of investments, and you've got the typical rate of inflation running right across at 10%. So we've got your cash ISAs just sat above 2%. So that is the leading cash ISA in the minute, which is a fixed term cash ISA for 1 year. Again, the number that I mentioned on the buy-to-lets, subject to market fluctuations, capital growth, etc., and being able to leverage a mortgage at the high threes. You've got the FTSE 100, just over the 6% in that year of 12 months from yesterday or today's date backwards. And then you've got Sourced Capital, which is averaging around about 11.9 something percent. On average per annum. So I'll let you jump into those, and I've took away quite a lot from what you might have said, but
yeah, no, I think you've summed it up neatly there, John. I mean, let's keep it simple, isn't it? What is the impact of inflation? Quite clearly, if you're if you're earning 2% and then the general economy is moving away from you at 10%, we could all do the maths, can't we? That's you're effectively 8% the wrong side. You've invested your 100,000, and on a net basis, on a like-for-like basis, the year after it's you've just lost £8,000 value out of your 100,000, and that's the very simple summary of this figure. You've summed up neatly where those figures have come from. I think there's a slight variance on the FTSE 100 from the previous slide, but that's probably just down to timings of when that particular slide number was inserted into this. But we'll come back to the issue of cash ISAs probably a little later in this chat, won't we, John? Because I know it's drawing a lot of conversation from market analysts and commentators. So, but I think what's important there is that figure there is the best performing that's currently available on Money Supermarket. Now, that doesn't mean I've got access to the whole market. I haven't, we've gone to a source that we can all look at. That figure is where that has come from. Now, that is a long way. I mean, it's not doing a lot, even if the Bank of England were hitting the 2% target, but clearly they're not. So it all comes back, as it does with the BTLs, as it does with the FTSE 100, as it does with however else you're looking to invest. You've got to take a view on where you need to be with regards to retaining the value of your savings. You need to put that against your overall risk profile and against your overall requirements, with the liquidity and daily, day-to-day living expenses. But those source capital figures, and John mentioned earlier, this isn't investment advice. Clearly, the one part of this we can talk about specifically, because we live it day to day, is source capital, which is why we use generics such as Money Supermarket when it comes to other providers. So yeah, those figures there that you're looking at, just below 12%. The targeted rate is 12% for anyone who invests over £20,000. The reason it's just below 12% is that we have a number of investors that have invested below that figure. Now, coming back to John's comment earlier with regards to how much has been invested and repaid, I think it's worth just underpinning that by saying that all of the capital that's been invested has been fully repaid, and all of the interest that was payable from those investments from the day it was invested through to the point it was repaid has been fully repaid. So so those interest rates that we've looked at on that previous slide are absolutely based on the targeted rate at 12%, which is for investments over 20,000, sorry. And the reason it's slightly below 12% is because there are some investors lower than that, not because any of the loans have underperformed.
Perfect. Thank you very much. And I've moved a couple of slides on. We'll move one back in a second, but just to show that we've got that average across the board from 2019, 2020 and 2021. So again, a little bit more about Sourced Capital. We've touched on pretty much everything here so far, really. So it's a peer-to-peer investment platform, which is FCA regulated, only solely dealing within UK property developments, whether that be a new build development, as you can see in the background, or it could be a refurbishment project, or it could be a commercial to residential deal. We'll always conduct rigorous due diligence on the project, compare that back to independent professional services such as RIC surveyors reports, which have been to site. We've got a 100% repayment rate, as Del said before. That is of capital that's been invested and the expected interest as well. And the investment terms are generally short term. It's between 6 and 24 months. And obviously you're fixed into the duration of that project. But we'll skip through this slide just because we've talked about it quite heavily. And then the main thing that we want to try and bring into this as well is, obviously, if you're looking to beat inflation and you're earning 10 or 12%, but then anything that you earn on top of that or with that, you have to pay tax on. Is there a way to invest tax-free? And that's the beauty of what a IFISA is, so a innovative finance ISA. So there's a question here that comes up, which is, has anyone actually used a individual savings ISA before? I'll launch this and then we can get a real feel for how much we need to delve into, whether we need to explain it quite heavily, or whether the majority of people have used an ISA in one form or another, whether it be a cash ISA, stocks and shares ISA, whether it be an IFISA, innovative finance ISA, what we do here with Sourced Capital. We've got quite a few answers coming through, and it seems like it's quite a split so far. We've got just over half which have said yes, they have used ISAs, with a little bit more has come through, a couple more votes coming in for yes, we've used them. We've got a few people which haven't used them, and then it's good to see that we've got a few people which haven't, but they are looking to them. It's a great tool that we'll start to delve into. There are a couple of drawbacks. There are some great benefits with them. Over the next few slides, hopefully we'll be able to get to them. And any more votes before I close it off? We've got a Yes votes now showing at 67%. So they've outweighed the no votes quite heavily in the end. We'll move on then to the next slide, and it was just to get an idea really. If we needed to talk more about what an ISA is and how it can be used, we can kind of hopefully be able to give information for the people which haven't used ISAs in a smooth, effective way moving forward over the next couple of slides. So, a individual savings account (ISA) was introduced on the 6th of April, so start of the tax year in 1999. The beauty with an ISA is that the returns that you receive into the ISA are tax-free. So once you've invested, the returns are tax-free. There's two slight drawbacks with them. It's on already tax funds, so it's money that's already sat within your bank following income and potential income tax. And then you're also limited to the amount that you can invest per year. So the limit, the allowance per adult over the age of 18, which is a UK resident, is 20,000 per year. The huge benefit, I think it's on a slide in the next 2 or 3, but the huge benefit once you've started to build up this pot over the years, so 20,000 investments year after year, you've invested that, you've started to compound the interest, again, depending on what type of investments you have, you can really start to build a huge pot with the ISA. And there's quite a lot of my investors which have got ISAs in excess of £1 million, just because they've built them up year after year. They've invested really wisely with it. Della, I'm guessing there's not much to add to this slide of what it is in the basic sense.
No, absolutely. I think I'm mindful that I might just be treading on your toes for something that's about to follow, but obviously the ability to move those balances from one provider to another is probably where certainly the likes of Martin Lewis is coming from, isn't it? Which even if your return isn't looking great, then actually don't necessarily just draw the money out of a cash ISA that's not performing well, because you will throw away those previous year's ISA benefits. Yeah,
great point. And I'm kind of doing the same. I know what's coming on the slides later, but so I don't want to delve into too much. I don't want to jump into the next few slides before we get there. But yeah, we'll talk about especially what Martin Lewis has said and having the cash ISAs and so forth in, I think it's a couple of slides time. But there was a question that came through regarding the 100% repayment record for Sourced Capital and the security that needs potentially to be enforced. What I'll do, Ian, if you don't mind, again towards the Q&A at the back end, we'll run into this alongside George's question of the borrowers and why they would invest, why they would borrow from Sourced. So we'll touch on that probably about another 5 or 6 minutes before we get to the Q&A at the end. So again, there's different types of ISAs. This was put together for a previous presentation that we did looking at ISAs and what they are. So we touched more on the styles of ISAs and the way people can invest right the way through. And we'll do the same again today, really. And the number that you've got at the top right is one that probably jumped out straight away of typical return 0.63. This has changed since then. Currently, the highs that you can see in the market is just into the 2s, what we mentioned earlier. But you've got your standard cash ISA, usually readily available if it's not into a fixed term, or it could be fixed in for a year, 2 years, 5 years or more. You've got stocks and shares. It can be a managed fund where somebody else is doing all the activity on your behalf and choosing the investments for you. It could be relatively low to high risk, depending on the type of fund and depending on how you're executing that. Just a stat that we've not put in here, but one that's readily available on any self-investment platform. But it's into the high 70% of regular investors, retail investors, which are investing into opportunities. I think it was about 78% of investors actually lose money when they're trying to navigate the stock market themselves, due to experience, due to timings, due to emotions that are involved with that. And again, that leads into then the type of return that you'll receive. Some funds can be relatively low, some can be relatively high. A stock that was mentioned earlier, Shell, if you pick that, exactly 12 months ago today, you could have 67% additional through the ISA. And then you've got IFISAs, innovative finance ISAs. The limit across them is all the same. You can split that limit as well. So if you wanted to have a diversified portfolio with each year's allocation, you can split that into cash, stocks and shares, and IFISAs. The risk with your IFISAs, medium to high, depending on the type of loan, depending on the security held, depending on the experience of the platform that's been able to bring the opportunities forward to you. The typical returns vary from around 5% per annum to 12% per annum. Del, as I do on every slide, anything further that you want to add in there or jump in or?
No, there's nothing missed there, John, is there? I just, we come back and I think this circles back nicely to something that we both talked about earlier, which, yes, interest rates are higher and performance can be higher in certain elements, but, that doesn't mean it's right for the individual. Everyone needs to be mindful of what their own requirements are, what their own risk appetite is, and if it's got to be liquid. So, I think it's a general sweep all across everything that we'll be talking about here in all the different kinds of investments. Individual circumstances will be different by definition, hence the word individual. And just do what's right for you. But we're here to try and give some generic views, and clearly the underlying message of it's not a low risk, it's not a low inflation world at the moment. So maybe more of us, and I, myself included, just need to take a view on is our position now the same as we were comfortable a few months ago.
Perfect. Thank you very much. I'm just getting slightly mindful of time, so we'll start to flick through a few of the next slides a little bit quicker before we jump into the Q&A, just because we've been on for just over 40 minutes now. So advantages of an IFISA or ISAs in general, really. The returns are tax-free, as I mentioned. You can do ISA transfers. So if you've built that portfolio of ISA funds up, you can transfer them into different styles of ISA or different breeds of ISA, and you can put those into different companies right the way through. And especially with an IFISA, it's peer-to-peer, so you are supporting entrepreneurs and businesses through the investment of what is peer-to-peer. A couple of questions here have popped through. Are there any? Oh, good question. It's one that we get asked quite a few times. Are there any percentage caps on stocks and shares returns? There aren't. So let's say if you've been able to invest extremely well, or you found a stock that's exponentially grown and that return is back into the ISA, there isn't a cap on what you can have returned back into the ISA for investment. There is a cap on what you can actually invest into the ISA. So that's where the cap comes. It's not on the amount that's repaid back into it. Again, that probably leads to why so many investors across the UK have got £1 million plus ISAs. It's by having the right investments and compounding that interest year after year after year. A question here, again, leading into the returns and what will be coming through, but how confident are you that the returns will be market beating in the coming years, which will be a challenge period? No, I'll let you jump into that one, and we can probably answer at the same time. We've gone through what Sourced is. We can probably answer the question that George had earlier regarding why borrowers would borrow from Sourced Capital at the same time, and it probably tends to align really well with that type of question.
Yeah, okay, John, no probs. So, why do borrowers borrow from Sourced Capital? In short, because we are a smaller lender, quite clearly, than all the multinationals and the nationals. Is that a good thing or a bad thing? It's a great thing if you're looking for flexibility around structure, because clearly we don't need a set of policies and guidelines that need to apply to X thousand people sat in different offices from Land's End to John O'Groats. So, the ability to look at each and every deal on its individual merits isn't just rhetoric. It's reality. Because we do look at every deal, and it's, you know, it's assessed in detail and analysed on regards of, you know, its key fundamental metrics, rather than trying to squeeze it into you know, a grid and some boxes that have to fit, you know, a national requirement. So in short, why do they come to us? They come to us because they need flexibility around the structure. They want someone who's able to support those, you know, their aspirations, understand what those aspirations are. But ultimately, where we are is, if there's a good scheme, there's the right project, we can get where we need to get to with regards to, you know, the borrower's ability, the likelihood of obviously that scheme going from start to finish, repaying the investors being able to receive that return, that there's multiple different exit options in there, and that the security stands solid. That's what we're looking to do. We're looking to produce a deal that works for that borrower first and foremost, and will get them where they need to get to, but in a way that works for us, Sourced Capital, so we're comfortable with it, and, you know, in a way that works for our investors to make sure that they can get that return. You know, the reason that we mentioned security earlier, and this probably is the extension that will hopefully answer Baraj's question, you know, is because, you know, the greatest will in the world, you know, I've been sort of doing this now for whatever, way too long, you know, well past 35 years, been lending money. You know, I think I'm quite good at it, but I wouldn't be stupid enough to sit here and say that, you know, something can't happen at some future date that would impact a loan. The security is there to clearly, you know, if something does go wrong, it's a safety net. That's what it's there for. It's absolutely a safety net. We don't pawnbroke. We don't lend against the security in isolation. We lend because the deal makes sense, that borrower should be able to get it from start to finish, generate the cash from either the sale or the refinance, and repay those investors their capital and their interest. And I think there was a question earlier, John, that someone asked if we've actually enforced any security, or look like we need to enforce any security. Answer to that is a categoric no. We haven't had a loan at any point where we've had to resort to that security, but clearly it is there in case of need if something goes horribly wrong with a project. But we monitor deals from start to finish. You know, we know where we are. There shouldn't be any surprises, but that doesn't mean something can't go horribly wrong. And that's what the security is there for. But no, we haven't had to rely on any security on any loan as a means of repayment. All loans have successfully performed, generated the cash, and repaid all investors, all capital and interest. Hopefully that sweeps the three outstanding questions up, John.
Yeah, you did really well. Thank you very much. So yeah, hopefully we'll have a couple more questions for the Q&A in a few minutes. So again, I'm mindful of time. Let's fly through the next couple, which we've already touched on. Are you eligible for an IFISA? Anyone over the age of 18, that's a permanent resident within the UK, is eligible for an ISA. And then we move into, again, another poll that we've touched on. So the first one was looking at effectively, have people used ISAs before? And the next one is, anyone ahead of the game? Has anyone used 2022, 2023 ISA allowance so far? So we're a month and a half into the new tax year, and you start to see those people that wait right until the end of the year, then they utilize it. You see the people which are extremely proactive and use it at the start of the year every single year. So you start to see a difference really between people's strategies, between whether they wait till the end of the tax year or at the start of the tax year. Again, depends on opportunities. It depends what's available at the time. And we've got a bit of a mix this time, more towards the no, but we're looking to use ISAs. And we've got a few people that have been ahead of the curve so far and have funded their ISAs. But the majority of people, we've got 65% of people which haven't yet used the ISAs. So yeah, it's a great tool. Again, if you're using that year after year after year, even if you're not maxing out that 20,000 every single year, even if you're just putting a small allocation in, it's a great way to build that pot. And if you are looking to put smaller amounts into the ISA, if you've got an ISA elsewhere, still do the ISA transfer. Don't pull that back into your bank account to then transfer it somewhere else outside of the ISA wrapper. even though you're not using the allocation. Still use the allocation and still use the transfers, because you never know what's going to happen over the next year, 2 years with funds that come through. We'll end the votes there with just over 67% of people which haven't yet used the ISAs, which is great. So hopefully we'll be able to send a bit of information out regarding the sourced ISA, and we'll put a link there to the government website if anyone's got any questions on what an ISA is further to this webinar. So then, looking at IFISAs, are not all the same. We've touched on security. We've touched on what we do here at Sourced. IFISAs can be, like we said earlier, medium to high risk, depending on the types of investments that go live, depending on the types of security. We don't need to delve into it again. We've already looked at it on a previous slide, so we'll move on to the next one of how you generally choose a IFISA platform or what they do. And similar to what we've talked about so far, we've been on for just over 50 minutes now, and we've spoke at length about the types of opportunities, the securities involved, the risks involved. A few things here to look at are the same points that we've made, but conduct your own due diligence, have a look and have control of where your money goes. Are you able to select the specific investment that you wanted into? Are you able to pick the specific stock that you want to be invested in? Diversify your investments across different developers, different locations, different platforms, different ISAs. Make sure that you've got a diversified pot within that ISA allowance. Can you transfer an existing ISA to one provider? A great question to ask when you're looking to move ISAs and put them with parties. Can they do transfers out? And if so, how is the organization set up for that? Because you don't want to build up this ISA pot, transfer it to a provider, and then realize that they are really difficult to deal with when they're transferring the ISA back to a different provider. Then you should know that you can only open one IFISA per year. So you can open multiple different breeds of ISAs, but if you open an IFISA and put any amount of capital into it, you aren't able to open another one. So just be aware of that as well. So once you pick your IFISA platform, that is your platform to put funds in for the year. And a final one before we jump into the last little bit of Q&A. Obviously, we spoke a bit about Sourced Capital. We've got quite a lot of investors with Sourced Capital on here today. You've spent 50 minutes listening to me and Dale talk. So if you want any further information about Sourced Capital, we've got an IFISA guide, we've got lenders guides. Just ping on, and then we'll get the results at the end. We'll put information over regarding our latest project that we're looking to fund, information about the ISA and the lenders guide, so you can see all the information involved with Sourced Capital and an investment with Sourced Capital. Leave it on for a minute or two, and while the last poll's on, the next slide will have our details on as a platform. But let's just have a quick look at the final couple of questions that have come through. So one here from Chris: can you reinvest your 1 million returns to reinvest tax-free too? So providing that those returns haven't left your ISA wrapper. So let's say if you've invested, just go pick easy numbers, say you've invested £1 million into anything, and then you've got £1 million returns in your ISA wrapper, then you'll have £2 million. If you withdraw that £2 million and then want to put it back into the ISA, you're limited to £20,000. Once you withdraw that 2 million, you don't need to pay any income tax on that 2 million that's been pulled out, because that's part of the ISA wrapper and the benefit of an ISA. If you keep that 2 million within the ISA wrapper, and then you reinvest that into the same investment that you've already held, or you transfer that into another provider, or you transfer that into multiple different providers, if you do an ISA transfer, then it'll stay within the ISA wrapper, and you're able to reinvest that, and then the returns on that are then again tax-free. So you start to really compound these tax-free returns right the way through. So I hope that's answered that one for you. The next one from John: are the ISAs secured against a single property project or a basket of projects? So with Sourced, Capital, the investment is against a specific project. The security is held against that specific project as well. So it's not a split investment portfolio against different styles of developments. And also it's not a investment into one project that has security over multiple projects. You invest into the one project that you're comfortable with and you're happy with the project itself, and then the security is against that as well. Question here from Andy. Well, the question with a few different parts. So let's go from top to bottom. So with Sourced Capital, is the 12% only available on 20k investments? That is correct, yep. So the rate of return is what Del mentioned earlier. So any investments up to 20,000 give you a 10%, well, I say 20,000. Any investments up to £19,999.99 will give you a 10% return. Any investments of 20,000 or more will give you a 12% return. So we've put that layer in place, mainly looking at the ISAs and looking at the allocation for the year. So if you do invest your fresh funds of 20,000, you are able to invest that into a source project, and that will be able to receive 12% returns per annum. Part B of that is you can still get the ISA tax-free as well as your SAS investment. So Andy's a SAS investor, utilising a small self-administered scheme of a pension. So yeah, the ISAs are completely separate entity, really. It's a personal allowance for yourself, not relating to a business, not related to the pension. It is effectively what it says. It's an individual savings account. So yep, you are able to use that as well as the SAS investments. And how does the term tie in with annual limits? So I kind of answered that at the same part or point of answering Chris's question. So the returns don't equate or don't eat into the allowance for the year. The allowance of monies going into an ISA are of fresh capital. So let's say if you're investing into an 18 months term and you invest in, let's say now, at the end of that return, obviously you're into a new tax year. The returns on that, or the capital that you've put into that project, go back into the ISA wrapper, but don't eat into that allocation. So in 2023, 2024 tax year, you still will have another £20,000 worth of fresh allocation of funds be able to go into it. And I think that is all the questions. Again, we'll stay on for a minute or two just to see if any further questions come through. Great news, the majority of people listening today want further information about Sourced Capital. Again, my details are on here. If you've got any questions or any further queries that you think we've not quite answered, or we wanted to go into a bit more depth on any of the questions, you've got two options. You can send me a direct email. You can email the capital@source.co email address, or you can give me a call. My diary is relatively flexible from now until the end of the day. So any questions, any queries, just let me know. And finally, before we go, I'd just like to say thank you very much, Del, for jumping on the webinar with me, answering quite a lot of the questions and taking the brunt of the information.
It's been good. Appreciate that. Hopefully, you know, as you've said, John, hopefully we've answered the questions as they've been raised to us, but please don't hesitate to get in touch if there's anything we haven't answered satisfactorily, or you know, you get that killer question after we do eventually be quiet and let people get on with their daily lives. But yeah, I think probably the final piece from me, if you don't mind, John, just to wrap that up and say clearly, you know, the headlines out of this were, you know, just be mindful of where your savings are versus inflation. You know, we've talked about different ways of investing. We've talked about different rates of return, and we've talked about ways of those, you know, returns even possibly being paid back, you know, on a tax-free basis, whether that be, you know, income tax or whether that be capital gains, you know, avoiding tax avoidance. That's a stupid word to use, wasn't it? But you know, sort of using the advantages of the ISA. But you know, the question that was asked earlier is a really good one, which is, you know, let's not lose track of those people who have got the SASs as well, because that is another way of you know, being able to generate these returns, whichever way you do that, on a on a tax-free basis.
Perfect. Thank you, Dale. And sorry, Dale, I know you've wrapped that up in a really good way, but we've just had a hand risen and a final question come through. It's always a great question right at the depth of, can I move my ISA to your ISA for this investment? Yes, potentially, depending on who the ISA's with, depending on the amount that you're looking to transfer. Again, depends on the timelines. What I'll do after the call, I'll pick that up with you just to run through what the logistics look like of an ISA transfer. But at this point, I can't see any reason why you wouldn't be able to do so. But we'll look into that in a call separate to the live chat. Perfect. Thank you very much, everyone. We should have another webinar probably moving into the end of next month. If we do, it'd be great for you to all join us again. One final question. I need to clock off in a minute, but one final question. Can you move any of your ISA returns to your SAS pension? Not directly from the ISA. You would need to pull them back into your personal name and then obviously speak to a SAS expert or speak to an accountant just to work out the logistics, but you can't do a transfer directly from an ISA into a pension. Well, thank you very much, everyone. Any further questions, just let me know separately and hopefully we'll be able to answer them for you. Thank you very much.
Thanks, John. Thanks, everyone. Bye now.